Good day. Ira Epstein of Linn Associates with your financial market wrap-up for this Thursday. And we're now on the 7th of March, 2019, just after 4 p.m. Central Standard Time. The event of the day was the European Central Bank cutting back the growth of the Eurozone, cutting back also the ideas of any interest rate hikes getting back to a normal policy, monetary policy, in 2019, adding the TLRTO program, in other words, the short-term borrowing program again, and just offering up a lot of dire ideas. And that hurt the market. It drove the euro to new lows for the contract, new lows for the year, drove the dollar to new highs for the year, new highs for the contract, and away you went. You had a certain amount of bids also come into the yen, which was up as safe haven, but by the end of the day, I was seeing the last quotes were closer to 89.61 than they were 89.72, so that'll be interesting. The interesting part was you did not hurt the energies, and you know, you're saying, well, things are slowing down. We've heard it from China. Energy still staying strong. Bonds and notes, of course, got crushed on this. In other words, the futures went up, yields went sliding down. The Bund got hurt too. So in looking at the stock market on a weekly area chart of closes, you can see that for the week we're down 55 points. So we've come off this 2805 level. We're getting that big correction right now. Okay, a correction was due. When you look at the chart here, you see how you've been sloping to the downside. It's more a case where people are worrying now, what do you do for an encore? In other words, you went up the first, 2 months of the year, and you went up 10, 12%. How do you add to that is the big question. We know that there's a Chinese deal in the oven. We're waiting to see if that comes out. North Korea not scaring people. A lot of people think it's a message that the North Koreans are sending, saying, come on, we really don't want to do this. We will. Work with us. You know, there's a lot of talk like that. But as I look at the chart action, what I see is a market that left an uptrend, and we have been discussing that this week. You now have a pattern of a higher high, lower low. Take the name off the chart. I could care less. You've got a higher high, lower low. As my definition goes, that's not a trend. A downtrend has lower highs, lower lows, an uptrend, higher highs, higher lows. This is a market that stepped out of what it had in place actually since the beginning of the year, the higher lows and higher highs. Where did the market fall into? Well, yesterday it began as the market slipped back to the 18-day average of closes. You can see that. Today the market closed at 2750 under the 200-day. Now, just closing under it doesn't mean a lot. It tells me that on rallies that could be numbers that become short-term resistance areas. When we look at Bollinger Bands, you can see how the top band's sloping down, and as support, the lower band is coming up. So the band is averaging right now about 10 points a day. It's going to be around, I'm guessing, this is just a guess, 2730s when we reopen at 5 o'clock today. That could offer some support. If it gives ground there, then the 100-day average could become the next support area. Momentum turned down before all this. This was your warning sign that the market had lost its way. Right here, momentum turned down, and it has basically been pointing down, and price has been chasing momentum. And that's how I'm viewing what's there. Bias is down, momentum down, and you stepped out of the uptrend. In the NASDAQ, the market at first tried its best to hold to the 200-day average of closes. It had lost its momentum just like the S&P. Next support would be the 18-day average. That's what it did, and if it goes further, then the Bollinger Band steps in. But very important, the market's now got a lower and low, higher high. So just like the S&P, we're not in a trend. We have bias down since you're under the 18-day average and momentum down. In the Dow Jones, you're in a downtrend. It's different than the other two. You've got lower highs, you've had lower lows. If you look yesterday, you closed under that 18-day average. It could set up a challenge of the Bollinger Band 200-day average. And if you had a lot of slippage, maybe you get to the 100. Does that mean it has to stop there? Of course not. But you look for the probabilities. And most times the market will trade, in fact 95% of the time, within the Bollinger Bands, these black dashed lines. So when you first go up to them, they're resistance, first come down, support. You don't change your opinion on that. In the Russell, you tell me. I kept saying this was the weakest of the indices. And why? Because it used the 200-day average as the resistance, and then it crossed under. You can see right here, the 18-day, this was yesterday. That puts into play this whole area today. If we continue down, you tell me what happened there. So the market came down to that area. I think the pro's recovering some shorts now at that number. Still bearish. In the VIX, often what I say is that the first challenge of an upper Bollinger Band or lower will bring out option sellers. Now what I mean by that, when you break down to the lower Bollinger Band, the put writers come out. Go up to it, I think the call writers come out. And the idea is to get back to the 18-day average of closes. In the bond market, we didn't have a trend. We haven't had one even since the break. You've had a higher high, lower low. You went down to the lower Bollinger Band. Now, could you push this sideways action out? Absolutely. And in order to do it, you first typically will get oversold and then embed. You got to look to see if the two come together. So you're hitting the oversold area. It's your first time out of the Bollinger Band. You get a spin back on Monday. You get a spin further on Tuesday with it. Okay, you're not dropping back under it. You start a rally process yesterday and you go right up to the 18-day average again. So what the market has effectively done is it shifted down the range it had been in, but it had no traction on the downside. It's not trending. You have the bias up because you're over the 18-day average, but no trend, a higher high, lower low, and momentum up. The 10-year note, same thing. I won't go through the whole chart, but higher high, lower low, tried to push, didn't succeed. And that's where the market came to its end. Even TLT. And in looking back, the first challenge of the lower Bollinger Bands in all these markets offered the pros, where their objectives, as it turned out not to be too bad of an area to come out of the market. This is still a downtrend in TLT. Lower highs, lower lows. The market is out of being oversold. So, did the pros hit this market with shorts? I wouldn't be surprised if they did today. They wouldn't want to see it over the last high here of 121. What is that? I'm not even reading well, but it looks like 02, whatever that high is. In the dollar index, now, understand the theory of getting over and under Bollinger Bands. When you first get up to them, is the market real bullish or bearish, do you think? It's real bullish. So the psychology is bullish on this, right? So here you are over it. But the concept of the band is that you only stay over it 5% of the time, 95 within it. Is this going to be a breakout of the band that is real, or is it going to result in the market, like we just saw in the bonds and notes, staying up here a day or so and then coming back? What I've learned over the years is that generally taking some money off at that top band, some, could be all your position, not. But if you're only a one-lot trader, what are you hanging around? You play the high percentage plays. That doesn't mean the market can't just run and away it's gone. I don't think so. I think it's overbought. First challenge, we'll see if it can hold it. Flip-flop to the euro. Each time you've done this, what has it done? Is that a buy signal? There's a huge difference in what I'm espousing here versus going long at these numbers to get back up there. It's not what I'm saying. There is a way to do that. And I teach it in my charting course and in my written daily research. It includes it too. I can tell you this isn't the setup, but it is the setup where I think pros took some money off the table on the short side. Notice how the British pound got up to, looks like it's blowing out, right? First time over the Bollinger Bands, 2 days, then you start pulling back in, and all of a sudden, you're right back at that line in the sand, the 18-day average of closes. So what I'm saying is you got to learn to work with momentum, got to learn to understand it and how it plays out. That does not mean you're going to get winning trades, but if you don't have the tools, you're probably never going to have winning trades. Or you'll stay in a trade and all of a sudden you go, why did I run that trade, that one that I had for whatever reason, into the ground? I'm just saying there are different parts that you learn. I teach those, and I hope that they have an impact on you. Do I know, am I the world's greatest trader? Absolutely not, okay? I'm just a guy that's done this for a long time, all wrong, and put down and learn from what I had done wrong. In the end, as long as the embedded reading stays in place, I'm bearish. Now, it lost it on the close today. If it doesn't get it back immediately, then what happens is the market stepped out of its downtrend. Maybe the safe haven money that's looking at the euro, the dollar, they're scared, who the heck knows. But that puts into play right up here. So now the question is tonight's reopening. I'm telling you the market was about 10 points lower. Will that re-embed that market or not? Don't know, but the bears are the one on the defensive now. The market stepped out of its downtrend. All that matters to me is does it regain the embedded reading tonight? In Bitcoin, you can see how the momentum's still pointing to the upside. You are not overbought. Neither of these numbers are over 70. The resistance is up here. The support's the 18-day average of closes. The trend is up. When you come to Brent versus WTI crude, you had a big swoop to the downside in the differential between the two. They narrowed in from nearly a $10 difference to about 8.5, got up recently, and now they're starting to pull back a little bit. As a group, though, they're pretty much going sideways. This is the Brent. It's got a pattern right now that's got divergence in it. You have higher lows, higher highs. That's certainly bullish. You're over the 18-day average of closes. That's bullish. It's a bullish bias, but momentum is pointing down. That's divergence. So you don't have all the pieces of the puzzle right. Then you come over to the Brent and you got the opposite. You've got lower highs, lower lows. That's bearish. Momentum's down. That's good. Unfortunately, it refuses to stay under the 18-day average of closes. Again, divergence. So the market's not telling us a story. In gasoline, I'm pretty much a broken record. Remember I was telling you, I said, during the spring, I don't recall in summer that gasoline prices are falling. I can't help it. When I come to work, I look at, as I go by service stations. When I say service stations, one. Remember, this is Chicago. Most people are in public transportation or whatever. I see one with a price, and I laugh because I know it's going to have, it's right now got a 3 in front of it for premium. It's going to have a 4 very soon. And I watch how this market's climbing again. Natural gas, still bullish. The pros are still in control. You have an embedded reading, higher lows, higher highs. You hit an area of upside targets. You've backed to the sidelines. It has not thrown out a signal that says anything, to me at least, other than on breaks, the pros are still buying this market. Lose the embedded reading and I'll change my opinion. You know, one of the things I try to do is I listen to you, and we get a lot of subscribers to our morning subscriber video because they're looking for an idea. They already have their trade idea in many cases. They've got a position. They're trying to understand, should they stay with it, should they get out of it, or they're looking to come into one. Talking to one gentleman, I think it was this morning or yesterday, he wanted to know about QQQ. So today I threw it into the charts. I said, it's not a problem. That way I can throw it out for some people. Understand the timing of what I do and when I do it. These markets, I all want them to be open. There's no point in me putting out an update at 7:30 in the morning when the grain markets close again and the meat markets don't open until 8:30 and the stock market itself doesn't get open to 8:30 a.m. I want the cash market open there. On the opening bell is when I start recording. So just about 8:30, 8:32, right in that zone unless something's gone wrong. I'm recording. It takes anywhere between 10, 15 minutes because I'm going through 40 charts at a time, and I am throwing out trade ideas galore. I'm talking for the person that's the in and out trader. I'm talking to somebody looking to see, is the market going to trend here? What are they doing? I'm giving you my specific trade ideas. I'm throwing out all the parts that I know and giving you that experience with the idea that if you have your own idea on a trade, your own thoughts on it, and you're looking for that push. Should I do it? Shouldn't I do it? Maybe what I say helps you out. And why is it timely? Because the market's just opened. Everything known about the market at that time, I'm catching up with. Got it? How do you get it? Well, it runs you about 26 cents a day to get signed up. Give us a call. Go to our website, www.iraepstein.com. Or if you're on our website under the words research or education, go down to morning subscriber video. You can also click up here if you're watching me on YouTube. It'll take you right to that page. I'm Ira Epstein. Have a good day.